If you look at their income statement, the way banks make money is very simple. There's fee income, which is like money they make from fees. Like when you do transactions, all those commissions on transactions that they charge you, or you want to print an account statement, there's a service charge, there's a fee. So all those services that the bank provides, there's a fee that they charge for it. But it comes nowhere close to how much money they make from interest income. If you look at most bank statements, the interest income is the biggest chunk of their incomes, right? So banks primarily make money by giving out loans and charging an interest on that loan. That you're not able to get bank money doesn't mean that the bank is holding on to their money. Any bank that is holding on to the money is wasting opportunity. In fact, if you leave banks alone, they will give away all their money. That is why the central bank has to ask the banks to deposit a reserve of their money. They call it a cash reserve ratio. I think cash reserve ratio or something, where the bank asks them to keep maybe 10% of their funds, 20% or 30%. Because if you leave banks, they'll give away all their money. Because the more money they give away, the more money they make. So to make sure that they are not in a terrible position, they now have to domicile some of their funds with the central bank for safety reasons, in case they give away all their money and you don't have funds again. In fact, some banks give away all their money and they start borrowing money from other banks. And of course, at some point, they can borrow from the CBN, even though the CBN is a lender of last resort. But primarily, that's how it works. I just want you to understand that banks are desperate to give loans. But what banks will not do is to just readily give away risky loans. You know, banks are conservative, and I've explained why. The money they are giving away is not their money. It is our money. If you have any account with any bank, that money is not just sitting in a vault somewhere. The moment you drop that money in your account, they are giving it to somebody who needs the money to build a house or buy a house, a mortgage loan, or somebody needs money to buy a car, an auto loan, or somebody who needs to build their business, a business loan, right? Your money doesn't just sit in the bank. They just keep a sizable reserve such that when you come to withdraw money, and the bank works on certain assumptions that you will not come at once to withdraw all your money. Or even if you're going to come and withdraw all your money, a very tiny proportion of customers will come at once and withdraw all their money. But most customers will just come and take a small slice of the money that they have. That is why Mike is good. So that is why there's a concept known as a run on the banks. A run on the banks means that maybe there's a rumor flying around, or there is low public confidence in the banks, and everybody is going to the bank at the same time to withdraw all their money. No bank can survive that. That's why it's called a run on the banks. So that's why when it happens, the regulators can come in and say, you know, they can assure people that nothing is going on, calm down, you don't need to withdraw all your funds, or that this bank is not failing. Even if it fails, you're going to get all your money, or they restrict how much money you can withdraw, like the Zimbabwe case. When there was a run on the banks, right? They restrict how much money you can withdraw. That's because no bank can survive all the customers coming at the same time to ask for all of their money, because the bank doesn't have the money. It gave out most of the money. So I need to, if you understand these first principles about how these industries and institutions are structured, you can then understand how to play the game. So the game is that banks give away their money as loans, but they won't just give it to any kind of person. Banks love short-term loans. It's less risky and very profitable. Long-term loans, they will not just give to anybody. They will give to customers who are low risk. How does a bank determine you are low risk? One way is collateral. Even if I don't know you and I don't trust you, if you can give me property that is valuable, it could be landed property, vacant land, it could be built-up property, commercial property, your home, it could be your car, it could be valuables, gold, jewelry, it could be an investment account that has stocks and bonds. If you can give me something that is valuable, that is as valuable as the loan you're asking me for, then you're low risk. Because what's the worst that can happen? If you cannot pay me back that loan, then I can go and sell your property and use it to recover my money. So that's why banks ask for collateral, because it reduces the risk significantly. If you can give them something that's valuable that they can sell, they will give you the money. Another way is guarantees. If somebody who is rich has money with the bank, has built a reputation with the bank, and the bank knows that person, if that person guarantees that you can be given a loan, what it means is that if anything goes wrong, they hold your guarantor, or your guarantor more or less guarantees that if you don't pay back that money, he or she will pay back. That's one way to drop the risk of a loan. Or for a short-term loan, the bank can say, we'll come to your shop, would value all your goods based on the goods that we're seeing. We can give you a loan. Because we can see you have assets, you have goods, you're going to sell them, you will make money. So they can give you a loan. A salary loan, if you work for a reputable employer, you work for an oil company, multinational, you have a steady job, Your salary is guaranteed cash flow. So a bank will give you a loan based on salary, which is why if you have a job and you're trying to start a business, one good source of capital is that if you have a steady job, that your steady job is collateral that you can use to get a loan, use it to finance your business, and then pay back. I have several people who do this. People who have their job and they are running a business, or maybe the man has the job, uses the job to raise capital from the bank, funnels it into the business, and the wife is running the business. Happens. That's another option, right? But the banks are an option you should explore because they want to give out money. That they are in the business of giving out money. If you're interested in learning more about the topics I offer when it comes to starting, building, and growing a business, this is your opportunity to join my community. It's known as the BMG. I provide extensive courses on different topics and challenges that afflict business owners, from how to optimize your profits, how to manage costs, how to boost your sales, how to develop processes, how to scale your business. There's a whole lot that I can teach you. If you want to go deeper into my content, this is your chance. Go to the link on your screen right now, jointhebmg.com.